Welcome back to our channel. Today, we're diving into a topic that's crucial for anyone running a business or even just trying to understand the financial world around them: liabilities. Specifically, we're breaking down the top 10 major types of liabilities you'll find in accounting. Now, I know what you're thinking. Liabilities? That doesn't sound like the most exciting topic. But trust me on this one. Understanding liabilities is like having the financial X-ray vision to see the complete picture of a company's financial health. It's not just about debts, it's about obligations, potential risks, and future commitments that can make or break a business. Whether you're an entrepreneur, an investor, or just someone who wants to be more financially savvy, this video is your guide to navigating the world of liabilities. We'll break down each type, explain what it means for a company, and give you real-world examples so you can spot them like a pro. Let's get started. First up, we're tackling something everyone's familiar with: bills. In the accounting world, those everyday bills are called accounts payable. Simply put, it's the money a company owes to its suppliers or vendors for things they've already received. Think about it like this. You order a shipment of coffee beans for your coffee shop. The beans arrive, you smell that fresh roast, but you haven't paid for them yet. That, my friends, is an account payable. It's a short-term obligation, usually due within a few weeks or months, and it's a constant cycle for businesses. Managing accounts payable effectively is all about balance. Pay too quickly and you might tie up cash flow that could be used elsewhere. Wait too long and you risk damaging relationships with suppliers or even incurring late fees. The key takeaway here is that accounts payable are a normal part of doing business. They represent the ongoing cost of goods and services essential for operations. Keeping a close eye on them ensures smooth operations and a healthy cash flow. Next, let's talk about those times when a business needs a bit of extra cash to, say, expand operations, purchase new equipment, or maybe even just navigate a seasonal slump. That's where notes payable come in. Imagine this: your bakery is doing so well that you need a second oven to keep up with demand. You head to the bank, secure a loan, and boom, you've got yourself a note payable. This is a more formal type of borrowing than accounts payable. It involves a written promissory note that outlines everything: the loan amount, the interest rate, and the repayment schedule. Now, notes payable can be short-term, like when you're bridging a temporary cash flow gap, or long-term, like when you're investing in something big that will pay off over time. The important thing to remember is that these notes come with interest. That's why it's crucial to understand the terms of the loan, shop around for the best interest rates, and make sure the investment aligns with your overall business strategy. Because just like with any loan, managing notes payable effectively is all about making sure the investment is worth the cost of borrowing. Now, let's talk about those sneaky expenses that can sometimes catch businesses off guard. Accrued expenses. These are the costs that a company has incurred but hasn't yet paid for. Think of it like this: your employees work all month, but payday isn't until the first of the next month. The wages they've earned but haven't received yet, those are accrued expenses. It's not just salaries, though. Think interest on loans, property taxes that are due every 6 months, or even utility bills that haven't arrived in the mail yet. These are all costs that are accumulating in the background, even though the bill hasn't landed on your desk. Why are accrued expenses so important to understand? Because they represent a company's true cost of doing business. Ignoring them can create a distorted picture of financial health, leading to inaccurate financial statements and potentially poor decision-making. The key takeaway here is that while we all love receiving invoices on time, the reality is that business expenses don't always follow a neat and tidy schedule. Accrued expenses remind us to account for those ongoing costs, even when the bill is still in the mail. So far, we've mainly focused on short-term liabilities, those bills and obligations that are due within a year. Now let's zoom out and look at the bigger picture long-term obligations. These are debts or financial commitments that extend beyond the current year, often shaping a company's financial strategy for years to come. Think about financing the purchase of a new factory, securing a mortgage for an office building, or issuing bonds to raise capital for expansion. These are all examples of long-term obligations. They usually come with extended repayment periods, sometimes spanning several years or even decades. Managing these long-term commitments requires careful planning and a deep understanding of the company's financial position. It's about strategically using debt to fuel growth while ensuring the company can comfortably meet those payment obligations down the line. Remember, not all debt is bad debt. In fact, strategically using long-term financing can be a powerful tool for growth and expansion. The key is to find the right balance between ambition and responsibility. Ever paid for something upfront, only to have to wait for the actual product or service? Well, businesses experience this too, and it's called deferred revenue. It's a liability that arises when a company receives payment for goods or services that haven't been delivered or rendered yet. Let's say you have a software company and you sell an annual subscription to your awesome project management tool. The customer pays for the entire year up front, but you haven't delivered a year's worth of service just yet. That, my friends, is deferred revenue. Think of it like this. You're holding on to the money, but it comes with a string attached, the obligation to deliver on your promise. As you provide the service each month, you can gradually recognize that deferred revenue as earned revenue. Deferred revenue is a crucial concept to grasp because it reflects a company's commitment to its customers. It's a reminder that sometimes receiving payment is just the first step. The real work and the real earning happens when you consistently deliver on your promises. Now let's flip the script and talk about unearned revenue, also known as deferred income. This is the other side of the coin from deferred revenue and represents the company's obligation to provide goods or services in the future for which it has already received payment. For example, let's say you run a popular online course platform. A student eagerly signs up for your 12-week intensive course and pays the full tuition fee up front. However, the course hasn't even started yet. This situation creates unearned revenue. The money received is not yet earned because you haven't delivered the educational content and guidance you promised. As the course progresses and you deliver each week's modules, you gradually earn the revenue and reduce the unearned revenue liability. Understanding unearned revenue is crucial for businesses because it ensures accurate financial reporting and prevents premature recognition of revenue. It highlights the importance of fulfilling commitments and earning revenue by providing value to customers over time. Chapter 7, Contingent Liabilities, the what-ifs of the financial world. Now let's talk about those liabilities that keep even the most seasoned business owners up at night, contingent liabilities. These are potential obligations that may or may not become actual liabilities depending on the outcome of a future event. Think of it like this. Your company is involved in a lawsuit. It's uncertain whether you'll be found liable and have to pay damages. And that potential cost, that's a contingent liability. It's hanging out there, casting a shadow of uncertainty over your financial future. Contingent liabilities can arise from various situations, such as product warranties, ongoing legal disputes, or even potential tax assessments. They are tricky because they are difficult to quantify precisely, as their ultimate impact depends on external factors and unpredictable outcomes. While it's tempting to ignore these what-ifs of the financial world, acknowledging and disclosing contingent liabilities, even if they seem remote, is essential for transparency and responsible financial reporting. Chapter 8. Lease Obligations. Renting your way to success and liabilities. In the world of business, sometimes it makes more sense to rent than to buy. Enter lease obligations, those liabilities that arise when a company leases assets like office space, equipment, or vehicles. Let's say you're a startup and need a swanky office to impress clients. Instead of shelling out a small fortune to buy a building, you sign a lease agreement. Congratulations, You now have a lease obligation, a commitment to make regular lease payments over a set period. These obligations can be short-term, like a one-year lease on a delivery van, or long-term, like a 10-year lease on a manufacturing facility. The key is to understand the terms of the lease agreement and factor those future payments into your financial planning. Lease obligations are a great example of how liabilities aren't always a bad thing. They can provide flexibility, conserve cash flow, and allow businesses to access assets they might not otherwise be able to afford. Chapter 9. Pension Liabilities, Planning for the Golden Years of Your Employees. Now let's talk about those liabilities that involve taking care of your most valuable asset, your employees, even after they retire. Pension liabilities represent a company's obligation to provide future pension payments to its employees under defined benefit pension plans. Think of it like this. You promise your employees a certain income stream after they retire based on their years of service and salary history. That promise creates a pension liability, as you need to ensure you have enough funds set aside to meet those future obligations. Calculating pension liabilities is a complex process involving actuarial assumptions about life expectancy, interest rates, and investment returns. These liabilities can span decades and require careful management to ensure the company can fulfill its promises to its retirees. Pension liabilities highlight the importance of long-term financial planning and the responsibility companies have to their employees' well-being, even after their working years are over. Chapter 10. Income taxes payable, rendering unto Caesar. What is Caesar's? Last but certainly not least, we have a liability that no business can escape: income taxes payable. This is the amount of money a company owes to the government based on its taxable income. Think of it like this. You work hard all year, earn revenue, and hopefully make a profit. The government, being the ever-present entity that it is, wants its share of those earnings. That share comes in the form of income taxes. Income taxes payable are calculated based on a company's financial performance and applicable tax laws and regulations. It's a crucial liability to manage effectively, as failing to pay taxes on time can lead to penalties, interest charges, and even legal issues. The key takeaway here is that income taxes are a fact of life for businesses. Understanding tax laws, planning ahead, and setting aside funds throughout the year can make tax season a little less taxing on your business. And there you have it, the top 10 major types of liabilities in accounting. We've covered everything from those everyday bills to long-term obligations that shape a company's financial future. Remember, liabilities aren't inherently good or bad. They are simply a part of doing business, representing obligations and commitments that come with growth and success. The real key is understanding what these liabilities mean, how to manage them effectively, and how to use them strategically to fuel your business's growth. By grasping the nuances of accounts payable, notes payable, accrued expenses, and all the other liabilities we discussed, you'll be well equipped to make informed financial decisions, mitigate risks, and ensure your company's long-term sustainability. If you found this video helpful, don't forget to hit that like button. Subscribe to our channel for more insightful content and share this video with anyone who wants to level up their financial literacy. Until next time, keep learning, keep growing, and keep crushing those financial goals. Understanding these can help you manage your company's finances more effectively. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insightful content. See you next time.